everybody this evening to the session. It's unfortunate we can't all be in person given the circumstances, but hopefully one day we'll get to meet in person. I am going to say up front, please forgive me if I have any technological glitches along the way or hiccups along the way. I've done virtual sessions in the past, but obviously different technology and sort of different mediums. Sometimes learning the different things and and how they work might be a little different. But anyhow, I just wanted to welcome everybody here, and I look forward to an interactive session. So please, as Navis said, ask away any questions you might have, either during the presentation or saving them for the end, whatever works best. My goal here is to really just help provide you with some of the fundamentals, if you will, around cash flow and financial statements and projections. So I'm going to just take a minute and share my screen, and we'll get started into our presentation. All right, so we should all see a slide now with my cash flow projection. Navis, maybe just give me a thumbs up if we're all good. Perfect. Okay, we're ready to go. So I thought we'd just start by talking a little bit about businesses. I know a lot of you are entrepreneurs recently starting your businesses, and we know that starting businesses is never easy. The good news is you don't have to do it alone, and YSpace has been really good at putting together this founder fundamentals, which really covers off a lot of the key topics that entrepreneurs need to be successful and to thrive in their businesses. So really excited about being here today and sharing some knowledge specifically around cash flows. I thought maybe we can just start off with a little bit of comic relief, especially in terms of what's going on around us in this day and age, but just a little comic strip here, accountant jokes, those sort of things. You can see it says, I found this in the hall, call accounting and find out if they've misplaced a decimal point again. And really just sort of, I guess the joke behind that is really that sometimes we'll look at our financial statements or we'll look at our bank statement and we always thought we might have had more than what we actually do have at the end of the day. So, so anyhow, take that with a grain of salt, but just some lighthearted entertainment for you guys. So why is finance and accounting important? Well, really at the end of the day, I do find in working with a lot of entrepreneurs, finance and accounting are often viewed as sort of overhead and not revenue generating. So why are we placing that much time on those sort of aspects? But unfortunately, if we don't spend the time on some of these things and we're just focused on sort of the sales component, it really could change things. And what I mean by that is if we don't know our numbers, we may not make the best decision. So there's a difference between I'm going to go out there and sell and actually, I'm going to go out there and actually make money. Because you can sell, but you don't know if you're not actually making a profit at the end of the day. And so it just gives you a little bit more insight to help you make better, more informed business decisions at the end of the day. So it is one of those I call necessary evils, if you will, in terms of making sure that you've got your house in order and that you have the information at your fingertips to know exactly what your revenues are, how much you've spent, how much money you have in the bank, sort of at all times. The other reason that they are important is really to help with meeting some of your compliance needs. There are tax filing requirements. So for any of you on this session that are incorporated in particular, there are tax filing requirements even if you're not making money. So I just want to put that out there. I've had a number of conversations with startup companies, and there's a bit of a misconception there that people think I don't need to file a tax return until I actually make money or have a profit. So that is not true. Once you've incorporated, there is an annual filing requirement there. So having your financials up to date just makes that process so much easier and make sure that you're meeting all your deadlines. And then obviously, as your company grows or you start looking to obtain financing or attract outside investors, they are going to be asking you for your financial statements. They want to see what your financial results are for a given period. So having those prepared and ready just adds another layer or level of sophistication to your business. So, so again, those are all important reasons to be able to dedicate some time and attention to the accounting and finance function within your companies. And I do recognize that entrepreneurs are often juggling multiple things and wearing multiple hats. So as an entrepreneur, you might be the accountant, the CFO, the CEO, the president, the sales guy, whatever it might be. But nonetheless, it is something that we should place some emphasis on to make sure we get right. So the goals for today's session is really just spending some time to understand those financial statements and what they are and what they look like and what they mean at a very high level, learning how to create a budget and looking at sort of cash flows and forecasts, an introduction to tax. We're going to talk about it just a little bit, just so that we can at least make sure that it's being considered as part of your business processes. And then talking a little bit about technology and how technology is helping a lot of small businesses and larger ones, but a lot of small businesses these days in terms of making sure that all their accounting functions are looked after in the most efficient way possible. If there's anything else that's not being covered today that you'd like us to cover, please let us know, and I'd be happy to consider that for either a future session or one-on-one, but happy to make sure that all of the content we deliver to you is relevant and in line with what you need to support your business. So let's start with understanding your financial statements. And the two key statements that you're likely most familiar with and have heard about is your balance sheet and your income statement. So, and we'll talk a little bit about what each of those are. There's also a cash flow statement that's typically prepared as well, and what we call equity. And the equity is the residual in the company in terms of what money or what profits you've earned and what capital has been injected into the company, and it's usually embedded within the balance sheet section as well. You'll see an equity component. So I just want to sort of walk you through those at a high level, but before I do, just thought we could maybe poll the group and just see how many of you actually prepare financial statements. And maybe we can use text chat for that. No, I'm not seeing the text chat. Great. Okay, Navis, can I get you to, oh, there it is, popped out. Sorry, must have been just delayed. Yeah, so good. I'm seeing some people say yes, annually, and yes, month. Oh, great, you read both my questions. Perfect. Yeah. So some people do it annually, some people file monthly, or sorry, prepare them monthly and incorporate it and file yearly. Anybody else? Annually. Yeah. Perfect. Okay, well, the good news is that there's a number of you that are actually preparing financial statements. Most seem to be on an annual basis, likely for your compliance reporting requirements in terms of filing your taxes. And I do see someone who's doing it monthly, which is fantastic because that just gives you more timely information for you to help with your decision-making processes. What I tend to see is annually for sure, and then maybe at a minimum quarterly. I know monthly is even better, but I recognize that sometimes that's just, there's just too many things to do and difficult to get to. But for those of you that are just preparing your financial statements annually, maybe consider moving at least to a quarterly update of those statements, just so you can get a clear snapshot of where things are at and not waiting till the end of the year, which typically could just end up being a surprise where you thought if we go back to sort of my original comic strip there, you might have thought you made more than you actually did, or maybe it's you spent more than you actually thought you did, or whatever the case might be. It's just good to kind of have a handle on those numbers throughout the year. But I'm going to say on a positive note, I'm glad to see that a lot of you are actually preparing them. Let's see if this works. Okay, so talking a little bit about the balance sheet. Again, I'll talk about this at a little bit of a high level and go through this rather quickly since most of you are filing, but it's just important to understand the difference between the different financial statements. So if you think of your balance sheet, it reports your assets, your liabilities, and your equity, and it's at a point in time. So for those of you, I'm going to use December 31st as a year end because that's a common fiscal year end for people and their companies. So that's really your assets being, say, your cash or your receivables as of December 31st. It could be it will be or could be different on January 1st. So it's important to note that that is at a specific point in time. If we look at the sample balance sheet here on the screen, you'll see this is just a snapshot of what it could look like. It's not pretty by any means, but it's just really to give you an idea of, you'll see it's broken down by some of the current assets and what those are, being cash, inventory, receivables. If you're in a service business, you won't have inventory. So just that's a slight difference here. You can have a different look to your balance sheet. Having your capital assets or fixed assets, language is used interchangeably, that would be part of your total assets. And then from a liability perspective, if you have an operating line of credit or some sort of overdraft or any accounts payable or even accruals that need to be recorded, those are all listed there. And then you'll have your longer term liabilities. And these are just examples. So you may or may not have all of these, but mortgages or long-term loans. And then you'll see the capital section, which is really the equity section, which outlines the number of shares and retained earnings in the company. So that's just a snapshot of the balance sheet. And remember, this is at a point in time. The income statement, on the other hand, is really gathering sort of the company's financial results over a period of time. And what I mean by that is it's over the 12 months ending on your fiscal year end date. So if we go back to our December 31st year end example, your revenues and expenses are going to be reported for the period of January 1st to December 31st in aggregate on the income statement. So you'll typically see this is where you find the revenues or sales numbers is on your income statement, which I know a lot of entrepreneurs are most interested about. It talks about, our income statement will deal with, what are some of the operating activities of the company, and what are some of the expenses that are being incurred and how much each of those are. So here's just an example of an income statement, and you'll see it's got, your revenues listed. Sometimes, there are returns and allowances that people provide if you're selling in, goods of any sort, but if you're in a service business, you likely won't see that. Cost of goods sold, and then your gross profit. And then below that, you'll see your expenses. So it outlines the various expenses you would have incurred during the year. Typically, you'll also see a comparative column to this. So for example, this just shows, results at December 31st, 2017, for lack of a better year here, but you would potentially also show the year before. So you can kind of compare year over year how your business is doing, or in terms of, have you seen an uptick in revenue? Have you seen, expenses relatively stay the same or more or less, or any, any changes to your business? And it just kind of helps you identify opportunities onto where you may be able to save on some expenses, or to just generally see, is your business trending in the direction that you had expected or would like it to. So, so that's really the income statement. Again, it's for the 12 months ending December 31st. So one thing I wanted to just point out on the income statement, there is a difference between sort of cost of sales and operating expenses. And the cost of sales is really defined as costs directly attributable to the goods that are sold if you're in the business of selling goods, or the services you provided, and it's really just the labor time that's put in to servicing your clients. From a product offering, some examples of cost of material, some examples of cost of sales are your cost of materials or your shipping costs that can be included in there, versus your operating expenses are really just defined as your normal business expenses incurred by the company. So it would be your expenses like your insurance, your rent, your professional fees that you may pay to somebody for preparing your tax return or your financial statements, and other costs. So So that's really the main difference between them. There is potentially a little bit of an overlap if you are in a service business and you do have salaries and wages. For example, they are typically operating expenses, but perhaps some of those salaries and wages are not what we call the overhead, and it might be directly related to the providing the services that you're selling. So you may have that in a cost of sales line item. So there's different ways to present some of this information, still within the accounting rules, if you will. The cash flow statement is another statement that really gives you sort of the sources of the cash that you've received, and it also will depict the uses of the cash that you've expended during the period. It is for the entire 12-month period. It's basically a reconciliation of your bank or cash amount reported on your balance sheet. And it basically says, you know, here's the profit that we made for the year from your income statement. Here's some of the non-cash items that we've, you know, added back. And then here's some of the changes in some of the balances within my accounts that have contributed to either an increase or a decrease in the cash that I either generated or spent during the period. And you'll typically see that the cash flow statement is broken down into sort of three main components, being operating activities, investing activities, or financing. So your operating activities are going to encompass, you know, whether or not did you collect your receivable balances, did you pay out your suppliers. Your investing activities are going to be things like, did you purchase capital assets or any startup costs that you might have had that, you know, in terms of investments that you made in the company. Financing activities are going to be, you know, is there any interest costs that you're incurring? You know, those sort of things sort of pop up into there. So you don't need to memorize all of this, but the reason why I wanted to sort of bring this up is because sometimes just understanding what these statements are telling us could really help us from the perspective of making the right decisions and really, you know, taking the time to not just make, you know, preparing your financial statements shouldn't just be a rote exercise at the end of every year. You know, speak to your accountant, speak to, you know, professionals, try and understand what the statements are telling you. And you know, the statements are at a point in time, yes, but maybe start changing the conversation with your advisors and, you know, okay, well, here's where the numbers landed, but what, you know, what do we want to do, or what can we do differently over the next 6 to 12 months to achieve the goals that we're looking to do. So I always say understanding the financials is half the battle, and it can kind of get you to make sure you're set on the right track for the next fiscal year. So I'll pause there. Any questions at this point? Okay. I'll just move along then. So the next section is really going to be on budgets and cash flows. So we're going to talk a little bit about that. If we could move to, I guess, tech chat again. Do you, and answer these questions, do you prepare a budget for your company? And if so, how do you go about preparing it? Let's see how well this works virtually. Okay, I do see there was a question, and I'll get to that one first before I guess we answer this question. But there was a question about what is other revenue, and other revenue could be things that are ancillary to your business. So what I mean by that is, if you're in the business of, I'm just gonna say selling books, your revenue is gonna be the sales you generate from those books. However, you might have some additional, let's just say cash that you might have invested in at your bank and been earning interest on it. That could be considered other revenue, for example. So there are, the other revenue section is sort of a catch-all for some of the other sources of income that you might have that you may not specifically define on your income statement. So I hope that answers your question, but if not, feel free to reach out to me or Navis directly, and I'll give you a little bit more on that. Okay, so getting back to our discussion question here in terms of preparing budget, I do see we have the comment that my accountant does it, but I want to learn more about this. So I'm going to say awesome, at least you are doing it, because having a budget is super important to really know where your company is headed from a financial perspective. So it's good it's being done, and absolutely great attitude in terms of wanting to learn more about it, because by you understanding it is super important. I almost see, and I shouldn't say almost see, I do see it as really being a collaborative exercise with your accountant if you're not familiar with the process. And the reason why I say that is, I think it's great to have an accountant prepare it for you. However, your accountant won't know your business as well as you do or what your plans are. So what I mean by that is, you know, and I'm an accountant too, and I can prepare budgets, that's not a problem, but I really need to spend the time with the entrepreneur or the business owner to understand, okay, here's what, you know, your historical results have been, but what are your plans for this year? And being able to put those plans on paper in terms of growth and projections and expenses that you anticipate to incur. It's always good to be speaking to your accountant and trying to prepare those together if you need assistance versus just letting your accountant prepare it. So just some words of advice for you, although not to say that you can't just have your accountant to do it. I just think you'll have a better budget if you work with them. Then there was a comment that not exactly, I just calculate how much income I'm getting, and if it matches all my expenses, we just don't spend money unless it makes sense. So you know what, the good point about that is that you're actually cognizant of what you're making and what you're spending, which is good. The only thing is, if you match all your expenses to your revenue, that means you're not going to have a profit at the end of the day either. So you might need to build in some assumptions there, or put some thought into you not just spending everything you're looking to earn or sales you're looking to make. So so just keep that in mind when working through the budgets. And then there's a comment, I've had a small provincial corporation for the past 5 years. My accountant filed at the end of every, I'm starting a new shipping and logistics that will be set up as federal. I will need to learn how to do this to obtain. What accounting software do you recommend? Okay, so there are a number of software packages out there. I don't have one that I, you know, would say is sort of the best software. I think it's just kind of looking at what softwares out there that's going to best meet your needs. But I'm going to defer that question till little later on in our presentation when we talk a little bit about technology. So I'll share with you some of the accounting packages available and that are commonly used by small businesses. So great question, just hold that thought, and if we will get there for sure. All right, so let's go back to our presentation. So just to talk a little bit about budgets and some of the characteristics in terms of the budget. So for those of you that are looking to learn a little bit more about budgets, I hope this gives you a bit of more insight into the budgeting process. When we're preparing a budget, it is based on assumptions. And what is meant by that is we are preparing it prior to us actually starting our fiscal year. So for example, if you have a January to December fiscal year, it's always best to do your budget in the fall of the year before. So if we're talking about January to December 2020, your budget should really be done ideally September, October of 2019, so that you could be, you know, ready to go on day one of January 1st, 2020 to be able to implement that budget and monitor the results throughout the year. So because we're doing it sort of at a different point, and I'm just using September, October as sort of the typical timing, you might even do it December 31st. If you start doing it in January, that's not an issue, but you're also starting your year out without really having a plan. So the sooner you do that, the better. It gives you some time to think through your assumptions, think through what might be happening. The budget is not something you sort of prepare and leave. You prepare it once, yes, but you might have to make changes to it. And what I mean by that is, you know, there might be a customer you were expecting to bring on board, but then that doesn't pan out. So how does that impact some of those estimates you made with respect to the revenues you were expecting to generate? So things happen all the time, and you just need to make sure that you're adjusting your budget for that, and then using your budget as a tool where you can compare your actual results to the budget amounts. So you're essentially estimating what your cash inflows and cash outflows are going to be each month, quarter, or the year. So I usually like to have at least 12 months. I actually like having 13 months because it's a bit of a rolling forecast at that point. and you actually have each month outlined in terms of what your sources or inflows of cash will be versus your outflows. And then you can group those. So if you wanted quarterly reporting, you look at your first 3 months, and then the next quarter you look at, the next 3 months, and even your 6-month year to date, and so on and so forth. So, and then by the end of the year, you have your full 12-month projection there for you, because it's important to use this also as a tool to make sure that you're going to have enough cash to bring you through the entire year and then some. It can be prepared for a company as a whole, which is typically what I see. And then sometimes you might even, depending on the nature of your business, you might do some sort of cash flow or budget for a specific project. Maybe there's, some additional attention that you need to put forth on a specific project or event that you're hosting, to make sure that if you are going to run this project, or if you are going to go through with this event, that it's actually going to be profitable for you. None of us want to be putting in all this time, effort, and work and then not make money or lose money, because it may not make sense for you to actually either hold that event or to go through with that project if at the end of the day you're already budgeting that you're going to lose money. So that's where some of these statements come into play to help you make better decisions as to whether or not it makes sense for you to, to do certain things in your business, because we're all in business to make money. Sometimes it doesn't happen that way, but if we already know that we're not going to make money before we even do anything, then we've got an issue. So we really need to make sure that we're looking at these the right way. And then I mentioned that they should be revised and updated on an ongoing basis as well. Some of the benefits is really just helping you assess where your expenses and revenues are and whether or not you're making money. It also helps you plan for any capital expenditures or other spending or investments that you'd like to make. Knowing if you have the actual cash and resources available to actually embark on those, helps you sort of plan your cash throughout the year. I find too, it's something just as basic as, are you going to be able to pay your employees, or, if you can't collect on some of your receivables, or if you're not generating revenue, you're still going to have some fixed costs out there that, in particular, if you have employees to pay, you want to make sure you're going to be able to make payroll. So this will help with that, and you can make sure that you're meeting all those requirements. Knowing if you have, sufficient money is huge. And then overall, and I've probably said this a few times now, and I'll probably say it a few times again, but really it's going to help you make better business decisions at the end of the day. You're equipping yourself with the data that you need to be able to make those better business decisions by having some of these tools in place to support you through the process. So if we wanted to think about this budgeted cash flow, really at the end of the day, it does tell a story of what you estimate will actually enter your bank account at any point throughout the year. At the end of each month, and that's why I say it's always good to do it monthly in terms of the breakdown of your budget. It's good to kind of see where your cash position lands at the end of each month, so that you know whether you've actually got cash in the bank or if you've gone into overdraft. And we all know that when we go into overdraft, there could be additional costs related to that, and you need to plan for those. So, and how do you fix that the next month or the month after that? So if you actually have less cash in your bank, or zero cash in your bank, or overdraft, you've basically spent more than what you have. And so you're going to have to figure out how you're going to fund that. Is it going to be through a loan? Is it going to be through a line of credit? Or is it going to be you as a business owner injecting your own personal funds into the business? So you need to make sure you've got your finger on this at all times, so you know how you're doing from a cash flow perspective. And it's not to say businesses don't go into overdraft. They do. There are certain businesses that are seasonal in nature, and there's going to be certain months during the year where they actually have to dip into their operating lines. And it's just because they need to do that to maybe order and use the goods, companies that sell goods, where they might have to purchase inventory in advance before they sell it. So they might have to go into an overdraft position to get the inventory to be able to sell it. And then it's only when they actually collect the receivable or get paid by the customer that they'll actually be able to get the money back. So there might be certain dips throughout the year where you are going to be in a negative position, and that's okay, but you need to manage it, you need to be okay with it, and you need to know that you still have sufficient cash to continue to be viable as a business. So hopefully that makes sense. What I do find just from working with a lot of startup companies is that startups don't fail because they aren't profitable. It's usually because they run out of cash. I think a lot of business owners place a lot of emphasis on their business model, generating revenue, you know, and trying to maintain those expenses. But cash is really based on some of the timing of when you actually have to pay out money to, say, suppliers, and when you actually collect money from your customers. So there could be a mismatch between the timing of those, which could lead you to running out of cash. And if those periods of not having cash are too long, if you will, it could impact the viability of your company. So cash flow is super, super important to make sure you have a pulse on that at all times. The other thing is, as you know, you're starting up a business. I know there's a lot of you that are, you know, haven't been in business all that long, and you might have some initial spend that you need to plan for. In particular, maybe some capital expenditures that you need to pay for. Plan for those. You know, it could be some fixed assets or equipment that you might need. Could be opening inventory that you need to purchase from your suppliers to have on hand so you can sell it to your customers. There might be some additional professional fees that you might incur when you're setting up your corporation, in terms of incorporation costs or legal fees or accounting fees of some sort that are going to be sort of those one-time costs that you're going to have to deal with. And you really need to just be prepared as to how you're going to actually cover those costs and where you're going to get that money from, because when you're starting up, you're really pre-revenue. So you need to have a plan to know where that money is going to come from. And you know, it could be a loan, line of credit, personal funds, or as I've noted on the slide, your rich uncle if you have one. So those might be some ways to make sure that you're thinking and planning for those. So when we're working through the budgeting process in terms of looking at our cash flows, there's, you know, we said earlier there were certain characteristics to budgets, and one of them is making assumptions, and those assumptions are really based on estimates. So there are going to be certain expenses that are going to be variable depending on sales volume, and what I mean by that is you only incur that cost if you actually have a sale. And then some expenses are going to be consistent month to month and are easy to estimate, and they're always going to be there regardless if you have that sale or you don't have a sale. So for example, your rent. It doesn't matter if you sell 1,000 widgets this month or 0 widgets this month, you're still going to have to pay your rent. So that would be a fixed cost that you would be incurring. And then there could be some other discretionary spend that you might be thinking about, and it's like, okay, well, it'd be nice to be able to have, you know, a digital marketing strategy and paying for that. But when's the right time to do that? I need to make sure I have enough cash or will be able to afford it, if you will, before I actually go on it. So that's why it's discretionary. You don't need to have a digital marketing plan. However, it's a good thing to have. And if you have the money, you might want to spend your money. So on that, but you need to make sure you have the cash. So discretionary is you don't have to, but you may want to. When we're looking at the sales side of things, in addition to estimating some of our expenses, we need to look at how much revenue you anticipate earning each month. And sometimes that could be challenging to do. If you're in the business of selling services and you have a contract and you say, I'm going to sell you, you know, this service, or you're going to pay them, I just use technology companies because that's probably one of the easier ones to kind of relate to and see. A lot of technology companies tend to have a monthly maintenance fee that they charge to their clients or their customers. And when they charge that monthly maintenance fee, it's usually a fixed fee and it's known and it's easy to, I'm going to say, plot onto your budget, because you know, okay, well, I have 10 customers that pay, you know, $100 in monthly maintenance fees. So I know I'm going to have $1,200 at the end of the year, or whatever it is. I'm not doing the right math, but you know, you can actually chart that out right across on your budget to know exactly what revenue is going to come in each month, because it's going to be consistent with the contract or the agreement that you have in place with your customers. So that would be easy to do. Where it becomes a little bit more difficult from the revenue side is if it's not nicely laid out for you like that, and it's dependent on, for example, how many books you sell each month. You know, it's going to be you guesstimating. Am I going to sell 10 books at, you know, $10 each in the month of January for $100 of revenue, or am I going to get 5 books at $10 each and only have $50 of revenue? So you can see like where you're estimating here could really change the numbers quite a bit. And those estimates really need to be based on some solid assumptions that you're making and really knowing your customer base and what you can deliver on. So trying to be as realistic as possible is super important. And then also consider, you know, there might be some months where there is seasonality to your business and you are going to have more sales in certain months versus other months that might be quieter. So keep all of that in mind when you're putting together your sales forecast. So just to give you some examples of how some people go about putting together their sales forecast. And these are super simplistic ways to do it. It could get as complicated as you want to make it, because the more detail that you put in will make it more complicated, but probably also more accurate. So keep that in mind. So the example we've used here is if you do have a past history of generating revenues, and let's just say if in the past your sales were, let's just say for 2019, your sales were 33,000, and maybe in 2018, your sales were 30,000. So that's a 10% sales growth. So you might say for 2020, I'm going to have another 10% sales growth over 2019, so 33,000 with a 10% increase is to 36,300, so that, you know, we know there's a history there of earning 10% growth per year, so that's probably realistic for me in terms of what my total revenue is going to be for the year. That being said, that's at the total revenue line item. You would want to break that out by month throughout the 12-month period to see which months you should expect more or less, or is that going to be evenly distributed across all 12 months of the year? So those are some assumptions that you're going to have to make and note them as well. The other way to kind of think about this too is, you know, determining what, and I find this is probably in your first year of operations, is finding the size of your target market and estimating what your share might be for that. So if your target market is, you know, $1 million market and you're going to make your share of that market's going to be 5%, then that would be, you know, 5% times $1 million. That's going to be the number that you're going to project as your revenue. So, and again, that would be on an annual basis, and you would have to look to see how you would break that out into some sort of monthly number to help you really get the details you need to make informed decisions throughout the year. So again, just some examples of how you might go about doing it. The other ways to estimate sales might be through contracts. So I use that technology company example where you might have certain contracts in place. You know exactly what the contracts you entered into are, say, from a revenue generating perspective. You know, I'm going to charge you X dollars for this service and X dollars for that service. And you know when those services are going to be delivered and completed, and you can use that to estimate what your revenues would be for those periods. And your contracts might span a year or 2 years, or it could span 3 months or 2 months or 1. So you really need to look at sort of your contract period as well to help you, you know, determine where those revenues would land and in which months would you be recording them. Another way to look at it too is looking at leads and you know, the number of leads you might have in terms of new customers, and what's been your typical conversion rate in getting, like, turning those leads to actual customers and doing a rough estimate of what the revenues might be based on those multiplied by whatever you charge for your services or the goods that you're selling. So there's going to be a little bit of math to do there, but that might be another way to look at it, or even looking at other similar businesses your size at a stage in their life cycle, and what their revenues might be and how those might compare to your situation, and whether yours would be similar or more or less than your competitors. So these are all just some suggestions on how you might go about thinking about forecasting your sales. So nothing is better than actually trying to put pen to paper and go working through these, because I know I've sort of talked about a lot of concepts and thrown a lot out there. But I think just to kind of bring this to life, bringing a practical example might be beneficial. And I think Navis had circulated a couple of templates in advance for this session. So I'm going to ask you to turn to that Excel, one of the Excel templates, and it would be exercise 1 relatively soon. Basically, just to kind of set the stage for you, we are looking at a company here called Becky's Bouquets. So your friend Becky, she just opened her own flower business, and she would like your help preparing a budget for her. We're using sort of December 1st, 2019 to December 31st, 2020 in terms of preparing our budget. So we're technically, let's just pretend we can rewind time back to December 1st, 2019, and sort of put this together from there. Okay, there's a couple things before I ask you to turn to your Excel schedule that you need to know as you're preparing the budget, because we'll give you a chance to kind of apply some of these comments from Becky to your personal budget, and I'll make sure that I keep them on screen as well once you're there. But some things she said is that we're going to set up, she said she's going to set up the store during December of 2019 and open for business right after New Year's. And she said, before I open, I'll need to buy a computer and some office equipment. I would like to hire 1 part-time staff member to assist with the bouquets. And then she also said that sales in the summer months are usually slow, so I plan on going to New York for a 3-day trade show in July. So those are a couple of things that she said. There's going to be more of them, but I'm going to sort of try and break this up in little bits. What I'm going to do is just stop sharing my presentation for a minute and bring you to the Excel template just to give you a few pointers to help get you started. And then what we're going to do is use some of these comments that have been provided by Becky to help us put together a budget for her. So just bear with me here. Okay, here we are. So hopefully you can all see this Excel schedule. This will be the same one that was circulated to you in advance. It might be a little bit small to see on my screen, but if you want to at least open up your version of the Excel, I can kind of walk you through it at a high level so that it's not as daunting. I know sometimes opening this up and not knowing where to start is usually the first reaction, and that's okay, you're not alone. So if we look at Becky's Bouquet here, you'll see that in column C we have December. That's December 2019. And the reason why we have December there is because she had indicated to us that that was the first year, or the first month that she was actually going to start her operations. And then January to December, right across the top in row 6, you'll see that there's sort of the 12 months after the first month she opened that are being reported here. So on a monthly basis, we'll look at it. So you'll see here too that we have our sales or cost of goods sold or purchases of inventory listed. Then we have our operating expenses and our total. You'll see that this looks very familiar to what you would have seen in your income statement. However, what we are doing here is recording it on a cash basis, and for accounting purposes, you may be using cash basis or you might be using accrual basis of accounting. And accrual basis of accounting doesn't necessarily match your cash. And so what I mean by that is when you start preparing statements under a specific financial reporting framework, there is going to be a requirement to use an accrual basis and not a cash basis. So for now, if you are, we are going to focus on the cash and not on the accrual, which means it could be different than what you're reporting here for sales, cost of sales, and operating expenses could be different than what you show on your income statement. So just keep that in mind in case you're wondering. And you'll see in the operating expenses, it lists the various expenses that Becky may incur with the total. And then there's some startup costs listed here, laptops, store equipment, opening inventory, and then a total again. And then there's what our cash flows would be, followed by what our opening cash balance was. So how much cash did we have in the bank, or how much did we inject into the company? And then we could see kind of whether or not we have a surplus, deficit, or break even at the end of the day. So if there is a positive number going in when you're entering it in, so for example, any sales would be at a positive number, and any outflows or expenses would be a negative number that you would input into the cell to show you what you got minus what you paid. So what you received in cash versus what you paid in cash, so that we can actually, the formulas should all be built in. Hopefully they're all working well, but you're all smart, so you can all figure it out. If it's not, and we can kind of come back to this. So this is the template that I'm going to ask you to work on. I'm going to give you a little bit of time to do that. I'm not going to be radio silent, because I will sort of give you a little bit of, I'm going to say, prompting as we go to help you fill in this exercise. Ideally, if we were here in person, I would be able to kind of let you guys go at it and walk the room and help you out. But I'm going to try and do this virtually and see how successful we are in trying to pull this together. And I'm going to give you a little hint. You may not all get to the same answer, and that's a-okay. It was actually intended for some of you to have different answers, because there's assumptions that we make when we are preparing budgets, okay? So that's my only hint to you at the moment. So keep your Excels open. I'm just going to go back to my PowerPoint and share that again with you, because we've got some key information on the slide that we're going to use. So again, now that we have our template handy, we're setting up our store in December of 2019, open for business right after New Year's. So when we look at that comment, if we're open for business right after New Year's, that means in December of 2019, we're expecting 0 revenue, correct? Because we're not going to sell anything until January at the earliest. However, before she opens, she's going to need to buy a computer and some office equipment. So there are going to be some startup costs around purchasing a computer and office equipment. And we do need to consider part-time staff member that she's looking to hire, and how much they're going to get paid, and when are they going to start. And then there's going to be some sales in the summer months that are usually slow, and she plans to go to New York for a 3-day trade show. So we're going to have to account for some of those costs relating to the trade show. So keep that in mind. I haven't given you any numbers yet, but I just thought it'd be important to look at that. Okay, so the first point is no sales projected for December, as the store doesn't open till January. Now, here we're starting to get into some numbers. So I'm going to give you a couple minutes to think through this. There's low sales volume for the first month. So January 2019, perhaps there's going to be sales of 50 bouquets at $40 each. So what do you think we need to put into our January sales box? And I'll give you a couple minutes to figure that out. Okay. So keep in mind that she said this is a low sales volume month for the first month in January. So that's 50 bouquets at $50 each. She's expecting larger sales for February and December due to Valentine's Day and Christmas. So she didn't tell you what it's actually going to be. So make some assumptions here and populate your budget in terms of what you think the sales might be for February and December. Remember, I said it's okay if we have different answers. The key here is that your sales in February and December need to be higher than your sales in January 2019, because those are your busier months. So you're going to need to make some assumptions here as to why what you think, how many bouquets do you think she's going to sell. And a hint is you might keep the price of the bouquet the same at $40 each, but it might be the number of bouquets that change. Okay, and then if you've done that, go on to the next one where Becky said that there's going to be lower sales during less busy summer months. So what do you think the sales might be in the summer months, and what assumptions are you going to make? Assuming that she's not going to change the price she sells her bouquets for at $40 each. And then there's going to be some months where we haven't talked about anything at all. We haven't given you any information, or Becky hasn't given us any information. So just put in what you think the sales might be in those months as well. Again, making some assumptions. So when you're done this, you should have, oh, sorry, I lied. There's one more slide with more information. Becky gave us a little more than I thought. There's also November. So we just look at your September to November. The sales are expected to be higher than those of the earlier months because of more repeat customers as well as improvements made from the trade show. So just keep that in mind for September to November. I think there'll still be some months you need to fill in anyways, so it's not all lost, but just use that as a guide when you're putting together your sales for September to November. Okay, her last comment is just my local area sees an average of 600,000 in sales of flowers per year. I think with my expertise, marketing, and connections, I can achieve 10% market share. So if we take the 600,000 times 10%, we're expecting maybe total revenue of 60,000. You may or may not have that number in your solution. That's okay. It's all based on assumptions that we're making, but what we'd like to do is kind of just see how close we are to this 60,000 that she thinks she could make in terms of some of the assumptions we made. So for example, if our total sales forecast for the year is, 100,000 and she's thinking she can only make 60, we may not have made some good assumptions along the way. So we may need to go back to revisit. If, we're at 55,000, she says it's 60, or we're at 62,000, she says it's 60, or 65,000, she said it's 60, we're probably okay. We're not that far off in terms of making estimates and assumptions. So it's just a little bit of a benchmark to consider whether or not we're on point with some of the assumptions that we're making relative to, her expertise here in this area. Okay, so that, hopefully you've all completed the forecasting the revenues on a monthly basis and in total for the year. There's a few other line items that she's provided us some information on, which is some forecasted expenses. So I'm going to leave it with you if you can just kind of read through these or, in terms of as you go, and I'll give you like maybe about 5-10 minutes just to make sure you complete them. But it speaks to what the annual insurance fees are going to be, what the salaries and wages are for the part-time employee, what some of her professional legal fees are, and then what she pays in rent. So using this information she's provided, populate the various expenses within the Excel spreadsheet with the amounts that you think and in which month you think that they're actually going to be paid. Okay, so I'll give you about 5 to 10 minutes. Okay, so once you've had a chance to input all of those items, there's going to be some other expenses that you'll see and that are listed in the Excel schedule that I'd provided to you. So what I'd like you to do is maybe just make some assumptions in terms of what you think some of those costs might be. But before you do that, think about, would you incur those costs? Would you not incur those costs if you were Becky? And if you were to incur them, how much would it be? So again, you're making assumptions here, and that's okay, but that's all part of the budgeting process and what you should be thinking about as you prepare your own budgets for your companies. So I'm going to give you a few more minutes to just sort of populate the other components of your schedule. Okay, so here's a suggested solution. So it's the reason why I say suggested and want to emphasize that is because let's go back to our basic principles. Budgets are estimates based on assumptions. So we may have, although some of the, I'm going to say facts have been provided to us from Becky, there are other items where we don't have any information from Becky. Becky may not even know herself what they would be. So we may have put together some assumptions, and if we were in Becky's shoes in terms of what we think some of those costs might be. So I want to just start by sharing mine with you, and then I'd be curious to hear what what others have done. But I'm just going to show you here. You'll see that in December for sales, there was 0 revenues recorded, and that's based on the fact that Becky said she wasn't going to start operations till January. And then in January, she told us that she was going to have sales of 50 bouquets times $40 each, so $2,000. And she also said that was one of the lower months. That being said, she also told us that February and December were likely her 2 months where she was going to have higher sales or highest sales because of Valentine's Day and Christmas. So this was just estimated February at 7,000, Christmas at 10,000. You might even have it the other way around. You might think that she's going to sell more flowers in February with Valentine's Day than she is in December. So it depends on what you're thinking when you're putting this together. And what I mean by what you're thinking is what assumptions are you making? So are you thinking maybe she's going to, December might be higher in this case, 10,000 versus Valentine's of 7. Maybe she's doing more Christmas parties or holiday parties there where she's actually, you know, doing some of the floral arrangements. So that could be potentially why December would be higher than February if she's got a lot more events going on versus February and maybe more walk-ins or deliveries of her bouquets. She's maybe expecting to sell a little bit less. So just, you know, or maybe it's in December, she prices her bouquets different at a different amount because the average bouquet size might be bigger and more expensive. So the reason why I'm saying this is these are all things we should be thinking about as we put together a budget and when we're making our assumptions and making sure that we're being realistic and we're using our knowledge of the business or use our knowledge of the marketplace, knowledge of our customers and what we, you know, how many we think we could sell unit wise and what our price points might be. We might need to revisit these along the way. If we find that we're not meeting some of our sales targets, maybe it's we need to readjust our price point. So, you know, that's why this is sort of a live living document that ends up getting updated throughout the year. So, so that was just a little bit, you know, an example of some of the thought processes. She also had made a comment about sales from September to November being a little bit higher, sales in July and August being lower. And so when she said they're lower, and she said that January was lower, here the assumption was that January, July, and August were likely going to be at the same level of sales, which is why those are all the same. And then the months that you are probably filling in are your March, April, May, June, and what do you estimate those to be? We didn't give any information or get any information from Becky on those, so you might have different numbers. So at the end of the day, this is all just based on assumptions. There's no right or wrong. The only way we'll know if we're right is at the end of December and what our actual sales come in at, and we can compare it to our budget. And you'll find that each year as you budget and you compare to your actual at the end of the year, you're going to get better at budgeting. Keeping in mind, though, that things do change and things do happen, but a little bit more experience under your belt in terms of knowing your business and maybe having a steady stream of customers in years 2 or 3 or 4, that's going to help you budget when there's a little bit more knowns to your business. So you'll see here the total revenues or sales were 56,000. That's pretty close to her 10% of the market of 600,000, the 60. Again, these are all, you know, this is just a suggested solution at this point, but if you found that your total revenues here, like I think I mentioned it earlier, were 100,000, you might need to revisit your assumptions because you might have gone too high somewhere. If you're in and around the 60,000 mark, plus or minus, let's just say 10,000-ish or so, you're probably okay. You're within the ballpark at the end of the day. So just double check your numbers there. From a purchase perspective, an assumption was made here that the cost of her bouquets was going to be 50% of her revenues. So basically a margin of 50% as well. You might have come up with a different estimate here, and that's okay. But the key is you need to come up with an estimate and make sure you have one. So in your case, for those companies that have been in operation for at least a year, you have the benefit of looking at what your margins, sorry, I shouldn't say just in operation, companies that actually have been selling or making revenue for at least a year, you'll know what margin you actually realized last year, and you might use that as a benchmark to estimate what your costs would be. Or maybe you just have better insight into what your actual costs are and can multiply it out. But those are some of the things that you'd be thinking about when you're completing that purchases section. So, so at the end of the day here, you'll see that the total purchases or cost of goods sold is really 27,000, which is just 50% of the total. looking at this, you'll see that it's a negative number, and that's because it's an outflow of cash versus your revenue number being a positive number and being an inflow of cash. So that's the difference. And then from an operating expense perspective, they should all be negative numbers because they're cash outflows. So in this case, there's some assumptions or some numbers that were provided to us. I believe, I'm going to go off memory here, but the insurance, she has an annual fee of $500,000 that's paid at the beginning of the year. So, sorry, did I say 500,000? I meant $500. $500 at the beginning of the year. So here an assumption was made that because she pays, or because the insurance is effective January to December and it's paid in the first month, the full amount of the expense was recorded as an outflow of cash in the month of January. If she had the option to pay this insurance expense evenly throughout the 12 months, this number would be different. It would be your 500 divided by 12, and you would have an expense each month. So what this is telling me when I'm looking at my budget is January is probably going to be a little bit more expensive month than my February or March or April, because I know that I'm paying for my full cost of insurance in January. So I need to have enough cash to cover that in the month of January. And then it'll lighten up my cash requirements in other months. The other one was there was some professional fees for legal and accounting, and we said it was $1,200. So in this case, when we're paying our professional services, if it was for example, for your annual filings every year, this $1,200, you might just be accruing it each month and saying, I'm going to pay my accountant $100 every month to cover off. Or it might be that you actually don't pay this $1,200 until December or January of next year. So you need to kind of adjust this expense payment in accordance with what your terms of your agreement would be with your lawyer or accountant. So that's just an example of where it could be evenly distributed throughout the year. It could be at a point in time that you pay the full $1,200. So you need to know when you need to make that payment and put that in. The other thing we knew is that there is rent that needs to be paid. So she pays $12,000 a month. Sorry, $12,000 a year for rent. So what we did here is we broke it out into, the rent is usually paid on a monthly basis. You don't usually pay all your rent for the year up front. So it's prudent to break out that rent expense or rent payment on a monthly basis. Our total is $13,000 only because an assumption here was made that she actually had access to the building in December when she had incorporated. So if that's not the case, then this would be 0, and in total we would have 12. So again, it's just some assumptions that are being made here. We would be able to ask Becky directly on some of these things, or yourself as an entrepreneur and business owner would know, but keep that in mind. And then you'll notice on the salaries, she was going to hire a part-time assistant and was going to pay $1,200. Well, if she hires that part-time assistant starting in January, when she actually is going to be selling, then she has a fixed obligation to make those payments to her assistant every single month. So that's why you'll see there's a $1,200 cash outflow every single month. That's being recorded for a total of $14,400 in expenses being paid out to her assistant during the year. Now that does not include any salaries that perhaps Becky pays herself. So this number could change if Becky decides to pay herself a salary, which she can and should consider doing if she needs the money from the business. So these are some things you need to think about when you're putting together your budget in terms of, how many employees do you have, what you pay them, and, look at their annual salary and divide by 12 months to come up with it. Or if you're paying people hourly, what's the average number of hours people work each month, and just take the average number of hours times the hourly or average hourly rate if you pay people different rates to come up with your estimate of what those salaries should be. Then you'll see that there's a few other expenses in here that I had said, think about them see if you would incur those costs, not incur those costs, and just, you know, make some assumptions and add them in. So one of the ones we didn't, you know, Becky didn't provide any information to us was, you know, advertising and how much she was going to spend there. So this is just, you know, some examples of maybe what might go out. She might do a little bit more advertising in January when she opens operations, and then it starts to level off. So, you know, more of a big splash for grand opening, and then lower numbers in later months. And then there's a little bit of an uptick in November for another 200 here, and that might be just closer to Christmas and trying to get her name and brand out there so that she can maybe support more holiday parties and sell more flowers that way. So those are some of the assumptions that came that were made when putting this together. Insurance, we talked about IT. There might be some IT costs that the company needs to incur. In this case, there was an assumption made that that would just be $100,000 every month. So maybe some hosting fees or cloud services or maintenance support, whatever it might be to keep your operations up and running. Meals and entertainment, it was a modest, you know, $50 per month pretty much in terms of, I'm going to say entertaining clients or guests. So you'll see that could be very different depending on the business that you operate in. The other one actually that I did give you some information on was the Becky and her conference in July to New York, because she had indicated that her sales are usually slower in that month. So she decided to go to a 3-day trade show in July. So that's why there's this $2,000 expense in July and no other travel expenses, because that represents the expenses she incurred while traveling at the trade show. You might have estimated 1,000, you might have estimated at 3,000 or 5,000. It doesn't matter. The key is that you actually estimated something to attend to that trade show based on what you think maybe flight, hotel might cost you in those months. I would also argue we may want to consider whether meals and entertainment expenses might be higher as well. So something to think about if we're out there at the trade show. And then there's just some website costs at a modest $50 a month for a total of $650. So the total operating expenses based on the assumptions that were made here in this particular example came out to $34,450. And so if I actually look at what my net profit or loss would be, I would basically take what my total sales were of $56,000 minus my cost of goods sold or purchases of $27,000 minus my operating expenses of $34,450. I'm actually already predicting a net loss of $5,450. You might have a different number. I'm just curious, and maybe we can turn to text chat just to see what you guys had. If you can just write down your total revenues, your total operating expenses, and your net profit or loss. I'm just curious to see what may have gotten. So can I just maybe ask you to do that and share that with me? Okay, I see someone else who's actually a couple of you have already come pretty close to where the suggested solution was, which is a loss of about $5,000. So that's interesting. We were making very similar assumptions. Okay, so I'm just going to carry on with this. So that's good. Well done to those of you who responded, and it looks like you guys are on track in getting sort of the key concepts behind putting together the budget. I wanted to draw your attention to something in particular here around the startup costs. So Becky had indicated to us that there was going to be some startup costs that she needed to incur, in particular around, you know, purchasing a laptop and some equipment. And so here there's $1,500 for the laptop and $5,000 for the equipment. One thing that I want you to sort of consider and think about is whether or not these are actual expenses and sort of one-time cash outlays, which you're going to make, which is true and will incur here in December. But from a financial reporting perspective, these costs might be treated differently on your balance sheet. And what I mean by that is this budget is showing the cash inflows and outflows. So when you buy a laptop, you need to pay $1,500, which is why the $1,500 is shown in December as an outgoing payment. On your financial statements, this laptop may not be an expense in your income statement of $1,500. It might be capitalized as fixed asset that you might amortize over the life of the computer. And usually it's really not more than 3 years because technology changes very quickly. So your expense in your income statement might be $1,500 divided by 3. So, you know, $500 every year. It's a non-cash expense, it's amortization expense. So that would be treated a little differently for financial reporting purposes, as opposed to how we're dealing with it here on a cash flow forecast model. So just wanted to bring that up because I know sometimes that could be confusing if we're thinking about it from an accounting perspective versus maybe a cash perspective. So that's why I've highlighted here, but nonetheless, these are outgoing payments and expenses that relate to the startup of her company that she needs to pay. And there's going to be a huge outflow in December as a result of incurring some of these startup costs. So that brings us to our cash flow line item. And so that cash flow is really taking what our purchases are, what our sales are, what our purchases are, what our total operating expenses are, and what those startup costs might be. So we're actually looking at, we need just under $10,000 in December of 2019 to be able to purchase the things or pay for the things that we've committed to. Then you'll see it changes every month. And you will notice that, unfortunately, there is only 3 months where she's in positive territory. So February, November, and December are the only months that she looks like she's actually going to have a cash surplus. And so not surprising because we knew that February and December were going to be her busier months. So she had more revenue anticipated to cover off some of those expenses and hence make some money. So in total, the cash outflow here would be $13,950 for the entire year. This makes the assumption, though, that the revenues that we generate each month, so for example, the revenues that we generated in the month of February of $7,000, that she actually collects that money in the same month. Given that she's in the business that she's in terms of selling flowers, usually most people pay on the spot. If she's got some larger contracts, for example, maybe for December when she's got holiday parties and might be dealing with corporate clients, she may not get that money up front or on the same month that she actually sells her flowers. She might have a plan in place that she agreed to with the corporation to say you pay 50% upfront and you collect 50% on the day of the event. So the cash flow for that would be different on this model if that was her agreement with her customer. So we need to understand what the terms and conditions of sale are so that we know what they would be. Another example might be if you have a company and you're selling goods and when you sell your goods, you give your customers 30 days to pay your invoice. Remember, anything you sell on December 30th is not going to be collected perhaps till January 30th. So that's a different month. So you need to take that into account when you're working through your cash flow or forecast and projections here, using and understanding the terms of your agreements. On the flip side, same with the purchases that you're making. You know, what are your terms with your suppliers? So when she's sourcing her flowers from her suppliers, what are the terms of her agreements with her supplier? Does she need to pay her supplier within 30 days, or does she have 45 days? Does she have 60 days? Or does she have to pay for it all up front? So you really need to understand the terms of the agreements to be able to support when these cash inflows and outflows are going to happen. So that being said, coming back down to our example here, and knowing that we have $13,950 in cash obligations, outflows really, at the end of the day, then we look at, you know, what was the opening cash balance, if any, and then how much is required. So in this case, in order for her, Becky, to come up with the cash, she had to look at financing. So you'll see in row 35, we've got some financing here. So the laptop purchase, basically she financed that. She also had to obtain a loan of $5,150 from her bank, and she also injected some personal savings of hers of $7,850 into the business, so that her total financing obtained was $14,200, which leaves her with $250 cash in the bank. So you could see how looking at total cash requirements, both on a monthly basis and on a yearly basis, really is going to set the stage for understanding your financing requirements and where you're going to obtain that financing from. And if it's not just personal sources or family and friends, you may need to provide them with financial statements of some sort to support past operations, as well as providing them with your cash flow forecast for the next 12 months so that they can get an understanding of what your projections are going to be, to know if it's, you know, I guess if they actually want to lend you money or invest in your company. So that just sort of goes back full circle to the importance of preparing financial statements and preparing cash flow projections. So hopefully that sort of brings the whole process to life for you. I apologize, this is all being done virtually and maybe not the same experience if we were all sitting in the same room, but nonetheless, hopefully you can see that there are a lot of assumptions and estimates that need to be made, and how the importance of, you know, being realistic, being reasonable, and staying on top of this really on a month-to-month basis is so important to the viability of your business. As another suggestion to this, what you could also do is maybe at the bottom of your worksheet or on another tab is list out what your assumptions are, so that you can go back to them and revisit them and rework them as you need to each month or each year. So that might be helpful to you going forward. So just a tidbit of advice, you may want to start tracking what your assumptions were when you were putting this together, because it may become the starting point for you when you do this again in the following fiscal year. Okay. And I see somebody's asked the question is, so for cash flow statement purposes, the computer is inputted the year it was purchased? Yes, absolutely. In the year or the month that it is purchased would be when it would show up as a cash outflow. That's assuming you pay for that laptop up front. If you're paying for it, so for example, if you buy the laptop and you're going to go on a payment plan of some sort and pay it over 6 months to Best Buy or whomever, then you would show your cash outflow and you would take your total laptop purchase divided by 6 months, or divided by 6, and plot it into the 6 months that those payments are going to be made. So hopefully that answers your question. Okay. So we've now spent time putting together this budget or cash flow forecast, if you will. The next step is to actually, at the end of the year or at the end of each month, which would be even better. So remember I said we broke out our forecast, cash flow forecast on a monthly basis. It would be prudent to be able to look at that cash flow forecast every month. So at the end of January 2020, we would look at what we had projected and compare it to what our actual cash in was and our actual cash out was, and see how well we budgeted. And then it would also be prudent to kind of look forward and say, okay, here's some assumptions I had made when I first prepared my budget. But given that now we're 2 months into operations and I have a better handle on what my business looks like, how many, our I know what some of my sales are going to be, or I landed a new contract, or whatever the case might be, you might need to go back and adjust this cash flow forecast that we just prepared and update it for new information. So that's why it's good to be able to keep this as a live document that you continually update for new information, and that you're constantly looking, and constantly is probably not the right word, on a monthly basis, looking at it to make sure that your actual results are in line with your forecasting. Because if they are way off, you need to revisit that, and your total cash position at the end of the year could be very different, and you need to plan for that. If you're like Becky and you need to inject personal funds to pay for some of these things, you need to know that. And you may not have those personal funds, so you need to plan to know how you're going to get those funds. Are you going to max out your credit cards? Are you going to be going to friends and family? Like, how are you going to pay for that? Are you going to be able to get a small business loan? You need to be able to plan for that. It doesn't just happen in the month that you need the money. So it's really important to develop some good relationships with even just financial institutions in the small business banking sector, so that you may not need any money today, but you might need it in the future. Or looking at BDC as an option. They're pretty good at supporting entrepreneurs and small businesses and making sure that they get off on the right foot. So these are just some examples of avenues you can take to help you get some additional financing, in addition to just out of trying to take it out of your piggy bank, if you will. So looking and comparing your actual results to budget, noting any significant differences, absolutely critical component of this whole process. And then making sure that you're using the data from the actual results and the budgets that you've created to see if you maybe need to think through how you're how you're pricing some of your services or the goods you're selling. So for example, in Becky's case, maybe if she's not hitting the sales targets that she had hoped for or anticipated, maybe she needs to consider offering some sort of volume discount to increase the sales. So, maybe if you buy 3 bouquets, instead of $40 each, you only pay $30 each. She may need to do that in order to increase her sales. And the other reason she may need to do that from a practical perspective is we all know that flowers don't last forever. So if she's stockpiling inventory and unable to sell it, she's likely going to throw away that inventory if it goes bad and not sold. So offering some price concessions to help at least get some money in the door instead of no money and throwing it in the garbage might be something for her to be considering to help increase her sales and minimize her losses if those flowers go bad before they're sold. And then last but not least, and I'd mentioned this already, but just want to reiterate the importance of it, is there's lessons to be learned from looking at sort of the budgeted forecast that we put together and the actual results, and readjusting as needed future months to take those learnings or findings and applying them going forward to future months and adjusting in total. So just want to sort of go through in a little bit of an example here of looking at budget versus actual. This is going to a little bit hypothetical, if you will. It's not exactly tied into our example here with Becky. So we're going to say here that the sales budgeted for the entire year were $70,000, and we know that the actual sales were $50,000. She had also anticipated a gross margin of 40%, but the actual realized was only 30%. And advertising expenses or payments totaled $1,000, which was what was budgeted, but only $700 was actually paid. So if you were to identify these variances, what would you be thinking about, or what should you be thinking about in each of these instances? So maybe we can just use the chat box to chat or unmute. I welcome people speaking if you're comfortable. It might be easier, but if you're uncomfortable with that, chat works just as well. So we're getting some good suggestions here. So we might consider, because we came low on the advertising expenditures or payments that we made. We only spent 700 where we were planning on spending 1,000. Perhaps if we spent a little bit more on advertising, we could have increased our sales. So that's absolutely an option that we would put forward. And then someone else made a comment that it looks like buying inventory was more expensive than she planned, causing the reduced margin. Absolutely. And so when we have a reduced margin here and things cost us more, something we may want to also think about is whether we have the right price point for sales. And sometimes we do, and it is right. It's just we need to maybe look at maybe are there other suppliers that could provide us the same inventory at a lower price to help us increase our margins. So those are some of the questions you would want to be asking yourself to assess sort of next steps in trying to make this, I'm going to say, more profitable for you. Yeah, maybe she didn't think about the cost of shipping her inventory, so she hadn't maybe planned for that. So that's a great point and definitely something we should add to our assumptions. And if she hadn't done that I'm going to use January, for example, then she should start doing it for February, March, April, May, June, July, August, and so on. So that's why that whole process of comparing sort of budget to actual becomes even more important, because we may not have considered something when we initially prepared the budget, and then when we see the actual results we realize, oh, we need to factor that in. So let's do that in the months going forward so that we have a better indication of where things might land thereafter. Having a regular inflow of inventory agreement with supplier, then just purchase extra during peak months. Yeah, good suggestions. What else do we have here? I think we have a few more. Okay, well that's all great. The other thing might be like, hey, you know what? We didn't spend a lot on advertising, and that's okay. Maybe we intentionally did that because we knew that we were going to be in a negative cash flow position. So we may have decided to cut some expenditures somewhere, and it may not just be advertising. Maybe there was some other expenses that they intentionally decided not to spend the full budget. So that might be another angle on this as well. So I just thought I'd throw that out there. Great, thanks guys, that was fantastic. Some of the other recommendations we might put forward if we go to sort of the Becky case is, I know she had hired a part-time staff starting in January. So one thing that she can do to help with her cash position is maybe hold off on hiring a part-time staff until she maybe gets busier. So it might help support her that way, or maybe she needs to revisit the number of hours that her part-time staff works. I know we say part-time, but what does part-time mean? Is that 10 hours a week, 15 hours a week, 20 hours a week? Maybe she needs to revisit that and maybe staff her or him in the months that she's busier for more time, and maybe less busier months for less, so that she doesn't have sort of that constant $1,200 right across her fixed costs of $1,200 every single month. Maybe some months it's $600, other months it's $1,200. So that's something to consider. And then, as you guys mentioned, maybe considering spending more advertising perhaps in the months of January and November, which are the months before her two peak sales periods, being Valentine's and Christmas, or she might decide to conserve the cash. And then the other thing might be raising sales prices, only if she can. You still need to make sure that you remain competitive. You need to understand your market. You need to understand what your competitors are charging. You know, if your competitors are charging, $30 for a bouquet, and this is just assuming that this bouquet is comparing apples to apples, and you're charging $40, then for sure you're likely going to lose some sales because people could get it for less. That being said, is there a geographical area that you serve? Are there any competitors in the same geographical area? So somebody could be, charging $30 a bouquet and you're at 40, but maybe it's because you're servicing a different area, a different market. Maybe there's a delivery charge, free delivery included, or maybe the $30 bouquet, they need to add a delivery charge. So those are some of the things you need to be thinking about when you're looking at, your sale price and how that fares against your competitors. All right, so that brings us to the end of forecasting our cash flows. Any questions at this point? Okay, if I've missed anything, I'm sure Nevis will keep me on track and make sure we catch them all at the end. So I'm just going to keep moving on just in the interest of time. So another concept that I wanted to introduce to you was the concept of break-even. And what we mean by break-even, just by definition, is we basically look at sales volume required to cover all our costs. So how many units do we need to spend in order to cover all our costs? Or how many hours of our time do we need to sell in order to cover all of our costs? And that means we're making zero profit. It's just all of our income that we make minus all of our expenses should, we would net zero is sort of the break-even point. So keep that in mind when we're thinking about break-even. Some of the key terms that we need to make sure we're comfortable with and understanding when we are trying to calculate what our break-even point would be is we need to understand the concept of variable costs. And variable costs are really costs that will change or fluctuate based on sales volumes. So for example, if you pay a commission to your salespeople, that's a variable cost because you only incur a commission expense when you actually sell a product. So that's a variable cost. If you don't sell anything, you don't pay commission to your salesperson. So that's why it's dependent on the sales volume. Your fixed costs are independent of your sales volume. So those are costs you're going to have to pay irrespective of whether you make $1 or not. So for example, if you have rent that you need to pay, you don't make any revenue a particular month, you still need to pay that rent. So that's a fixed cost that you're going to need to cover and make sure you have the cash in hand to support that even if you have zero revenues. And then your contribution margin, which is what we use to help us in calculating our break-even, is really looking at what your sales price is. So what do you sell your product or service for, less your variable costs per unit of sales. So we're going to go through an example to kind of bring this to life and make it real as opposed to trying to memorize some definitions. So let's put a practical spin on this. We are going to do a break-even calculation here. And our break-even that we're going to be calculating is based on number of units. So we're going to assume here that we're selling goods, and how many goods do we need to sell in order to break even. And the actual formula to compute the break-even calculation is to take our total fixed costs divided by our contribution margin per unit. So I'm just going to go back to the previous slide to show you what that is. So we talked about fixed costs, or costs that are independent of our sales volumes. So for example, the rent example I gave before, or the insurance expense you need to pay, that's your fixed cost. And then it says divided by your contribution margin per unit. And your contribution margin per unit is your selling price less your variable cost per unit. Okay, so that's what we're going to be calculating. So total fixed cost divided by contribution margin per unit. So we've got a little example here, and I'm going to ask that maybe you, oops, sorry. I just have to move this window here. It's covering up my slide. I'm going to ask that maybe you just pull out either your Excel schedule on your computer or a piece of paper, it doesn't matter, but let's go through these case facts, and I'm going to ask that you determine what, or compute what the break-even in units are. So basically, we've completed the budget. Becky came back to you and she said, I looked at my numbers more closely. I sell each bouquet for $40. So $40 is her selling price. She said that it cost me $12 to purchase the flowers and $1 for packaging. So we know that she's got $12 for every bouquet relating to the purchase of those flowers and $1 that she pays for packaging. And then her staff, she pays $15 an hour. But within the hour, her staff can actually assemble 3 bouquets in an hour. So we'd have to break that down into what would be the cost per unit or per bouquet in this case. So if she can make 3 bouquets in an hour, that would tell us that Becky's paying her $5 for every bouquet that she puts together. And then Becky goes on to tell us that she's got the following costs that she's going to incur: rent of $12,000, IT of $2,000, insurance of $500. So in this case, her rent, IT, and insurance are actually fixed costs. So ignore the last point for the time being. Let's just start with trying to compute the break even based on the units that she has described, or sorry, based on the data she's prescribed to us here. So calculate what your total fixed costs are, and then we need to divide it by our total contribution margin per unit. So calculate what our contribution margin per unit is. So do that first, and then we'll do the last point, and we'll come together and look at our solution. Okay, if you were able to compute the break even, we're going to take it one step further. Once you determine how many units you need to sell to break even, what would the results be if you wanted a profit of $30,000? Just take a stab at that, and I'll walk you through the solution. So how many units would you need to sell if you wanted a $30,000 profit? So your break even, remember, is getting zero profit. Now we want a $30,000 profit. So how many units would I need to sell to get that? Okay, let's go through this. So if we're looking at our example here, Becky said that she sells each bouquet for $40. So this is on a per unit basis. We know what her variable costs are. So to purchase those flowers, it costs her $12. Sorry, for every bouquet, again, this is per unit, $12. Her packaging is $1 per bouquet. And we know that she pays her part-time assistant $5 for every bouquet. So her total variable costs are $18. And if we take the selling price per unit of 40 minus the $18 in variable costs, her contribution margin is $22. Then we look at what our total fixed costs are, and our total fixed costs add up to $14,500. So if we look at, oops, sorry. If we look at our total fixed costs here of $14,500 and our contribution margin per unit is $22, then she needs to sell 659 bouquets. I was scrolling down realizing that my Excel was a screenshot and not Excel, so I don't have the solution to the 30,000, but basically what you would do in this case is actually take your total fixed costs plus your $30,000 profit divided by your contribution margin of $22 to see how many bouquets you would need to break even. So that's how you would get there. So I apologize, I don't have it here on the screen, but nonetheless, that was one extra step over the break even in units. So hopefully that all makes sense. If there's any questions, feel free to reach out. I'm not seeing any unless I'm missing any, but hopefully you're all comfortable with that. So why is break even important? Really, at the end of the day, you need to know whether you are either setting the right selling price for your product or managing your costs so that the goal here would be to break even with the least amount of units, but yet still remain competitive within the marketplace. So you need to kind of look at all of those inputs that go into that calculation to see how you could reduce the number of units you need to break even, either by adjusting your cost or increasing your revenue. That being said, maybe we are like at the right spot. Maybe we do have the right revenue. Maybe our expenses are what they are, and that's okay. But you need to at least do the calculations and revisit sort of the inputs and the costs and the selling prices to make sure you've got it right. Because sometimes what happens is when you first start your business, you end up potentially lowballing some of your, selling prices for the products that you're selling or services you're providing, because you're trying to get entry into the market, or you're trying to get some customers, and you kind of hope for referrals and word of mouth. So, you might go in at a certain number, but then once you start gaining traction and getting more customers, you might need to think about whether that number could be higher now. Like maybe you were priced below market, and now you need to be operating and selling at a price at market. Now you're a true, player in the market. So those are things that, you should be thinking about as your company evolves. So just from a cash management perspective, and some key takeaways is we really need to focus on some of our key working capital metrics. And what we mean by working capital is basically the liquidity of your company and what your current assets are versus current liabilities, and be aware of those. Always be aware of, controlling, be aware of what your cash is, control your cash inputs and outputs, and looking for ways to conserve cash as much as possible, or maybe even deferring some cash payments if you can, to help you manage your cash position throughout the year. The other thing to think about too is, it's great to have a sale and record a sale, but you need to maybe consider, who your customers are, and check their credit worthiness before you actually sell to them. Because just because you sell to somebody and you generate revenue, it doesn't mean you'll collect your payment. So if they aren't able to pay you, or they don't pay you within the terms allotted, so for example, if you have a 30-day term to pay and they're paying you every 6 months, that might not be feasible to you in your business if you're not collecting until 6 months later. So you may not want to sell to them again going forward. So that's just something for you to consider as well. And then, looking at your credit terms and what is considered appropriate. Usually, in order to help with your cash position, is having a shorter sort of credit term with your customers and a longer credit term with your suppliers. So in other words, getting your customers to pay you in a shorter period, let's just say 30 days, and maybe you paying your suppliers every 60 days, can help you manage some of the cash flow where you're actually using the money you collect from your customers to pay your suppliers. So that can help you, and you may not have to dip into an operating line or personal funds or whatever the case might be in terms of how you're going to obtain that financing. So that's just another thing to consider. And then monitoring your inventory cycles. So, what are your buying patterns, and maybe spreading them out throughout the year. Maybe it's a just-in-time inventory if you're able to do that. It really comes down to your business and how you're going to manage that, because inventory is a huge cost that you could bear, and you don't know if you're going to be able to sell it all, so you're going to be left holding the bag. If you're in a service business, obviously you don't have inventory costs to hold, but maybe you hired people because you're selling time and services, and you're not keeping them fully utilized and busy. So that would be considered, similar to your inventory costs. It would just be salaries and wages that you're paying, and not providing any services. So you've got the expense, but not the revenue. So those are some things that you need to be thinking about from a cash management perspective. So that brings us to tax, which is an interesting topic anytime, but late in the evening could be a little more daunting. But I promise that this is just an introduction and very light, and it's just to kind of get you acquainted with it and know that it's here. So just for fun, in this world, you've probably heard this, nothing is certain but death and taxes. So we're always going to have to make sure that we understand taxes is a key component to running our business, and we need to make sure that we're aware of our tax situation and comply with our tax filings. So earlier I'd asked how many of you had prepared financial statements, and through that some of you also responded that you were preparing them at the end of the year when you were filing your taxes. So I'm going to skip over this discussion question because I think a number of you are filing your taxes, which is great. But I just want to reiterate a point that I made at the onset of our presentation today, was that you need to remember that once you incorporate a business, you are required to file a tax return, irrespective if you had generated revenue or profits or anything of that sort or not. So just know that, because that is often a misconception. And I've spoken to a number of startup companies where, you know, they were incorporated 2 years ago, and when I asked them about, you know, have they kept up to date with all their tax filings, they're like, no, I've never filed a tax return. And, you know, I didn't think I had to, and I didn't make any money, so I don't have any taxes to pay, or I just had expenses and I don't have tax to pay. Well, it's very important that you still prepare a tax return each fiscal year, and you report that to the government. And even if you do have losses, that's okay, because your losses can be carried forward into future years when you are profitable and applied against future profits to help reduce your taxes payable. So moral of the story is you have to file a tax return every year, irrespectively from incorporation on. And the other thing is that I just want to throw out there is a number of startup companies don't even realize that they have an option to select their fiscal year end in year one. So please know that you do. Once you've incorporated a company, it usually kind of happens on a weird day during the year. So for example, you know, you might be incorporated as of July 17, 2019. You then have an option to select your fiscal year end from there. So, you know, it might be December 31st, and if it is, then you would be required to file a tax return from July 17, date of incorporation, to December 31st, and then the following year you would be on a January to December filing requirement. So just keep that in mind. That's sort of how it works for startups, and you are still required to file your return. Okay, so just in terms of taxes, I want to talk a little bit about personal taxes. And unfortunately, if we were all together, I'd be able to, you know, we probably would have gotten to know each other a bit better at the onset, and been able to go around the room to get a sense of how many of you are sole proprietors versus how many of you have incorporated your business. But I wanted to throw this in just because it's important to note that if you are a sole proprietor and just self-employed and you have not incorporated your business, then you are still required to file a tax return, but your business income gets reported on your personal tax return. And so that's a little different than filing a corporate tax return. You still have to file your tax return, but some of the deadlines are a little different. So for personal income taxes, our personal income taxes are usually due April 30th every single year. However, thanks to COVID-19, the government has given us an extension this year. So all personal tax returns, we have a filing deadline extension to June 1st, 2020. And if you owe taxes, the payments are not due till August 31st. That is this year only. In our typical sort of year when we're not dealing with the pandemic, you know, everything is due April 30th, the filing of the return and the payment of taxes. This was just a government relief program that was put in place to help individuals, given that we've got staggering number of people that are on unemployment right now. So this was just a measure to help from a cash position for our people. So know that if you are self-employed and filing for June 15th as a business, then if you have like a business number and all that sort of thing, then you do, it is still June 15 this year, it's no change, but you are able to defer any payment of taxes owing until August 31st. Typically on a normal year, and I put that in sort of air quotes, it would be June 15, your filing deadline. June 15 is actually your payment deadline if you owe tax. So I just wanted to bring that to your attention because it's a little bit of a nuance this year, and I just think it's important to bring that up with this group and know that, you know, as we're talking about cash flow here, this is one thing that I know I've been talking to a number of my clients on is, you know, yes, let's get your taxes done and filed, but you have time to make your payments. So it kind of helps a little bit from a cash flow perspective, because a lot of businesses these days are cash strapped, right? Because our revenue numbers have dropped given the pandemic, but yet we still have some fixed costs that we need to pay, in particular some of our employees. So having a little bit of a break and a little bit longer period to pay always helps from a cash perspective. So that's why that's there. And know when you're paying tax on a personal level or for your personal tax return, the rates are graduated. The lowest combined federal and provincial rate. So federal, there's always a federal and provincial tax rate that's included when we're computing taxes. And so given we all, I think, are in Ontario, I've used just the Ontario rate. This rate would be different if you were living in a different province. But in Ontario, the lowest tax rate is 20% or 20.05% on income less than $44,740. If your income goes to $44,741, that 20% increases, it goes to a higher rate. So that's what we mean by graduated rates. And our highest combined federal provincial rate in Ontario is 53.53% on income greater than $220,000. So if somebody is earning income of more than $220,000, they're paying almost 54% in tax. This came into play actually a few years ago, right? And unfortunately, the running joke at that time was, you know, if you've had to pay more in taxes than what you actually keep in your pocket, it's not a good thing. But at the end of the day, it's just the way it is. But we need to understand that we are making money and we all need to pay our taxes. So it just changes depending on income. And the reason why I say this is you just need to plan for it from a cash flow perspective and know how much you're going to have to pay depending on your income levels. So be aware of that. If we're looking at our corporate tax rate, usually the small business rate for Canadian controlled private corporations is about 12% on the first, on the first 500,000 of active business income, and then anything over and above the 500,000. So if you made $700,000 in income, 500,000 of it would be taxed at the 12% rate, and then anything over the 500,000, so 700,000 minus 500,000, that 200,000 would be taxed at the 26.5%. And this is again for active business income. There's a whole bunch more complexity in terms of active business income versus investment income versus other things. So for now, we're just keeping it simple on what your business income would be. So there is a benefit to small businesses. That small business rate has been on the decline over the last few years. And again, it was measures put in place by the government to help support small, medium-sized enterprises in their tax situation. So you could see here that having a corporation, there are some benefits here in terms of earning some profits and potentially paying lower taxes versus that income being reported on your personal tax return and having to potentially pay a higher tax rate depending on where your total income lands. That being said, there's lots of pros and cons to corporations versus being a sole proprietor and putting it on your personal taxes beyond just sort of the tax situation. It also comes down to, and if you've been speaking to any lawyers, you know, sometimes it just comes down to protecting yourself by incorporating. You know, your risk is really limited to the corporation versus any of your personal wealth. So there's lots of things to be thinking about. I'm not a lawyer. I'm not going to profess to be a lawyer and be able to provide you all the legal advice, but I do recommend if you are at that stage where you're, you know, thinking about incorporating, haven't incorporated, it's always best to speak to a lawyer and also to an accountant from the perspective of setting it up in terms of, you know, what you might be able to do from a tax planning perspective in terms of you know, who the shareholders might be or different classes of shares, and really accountants and lawyers work closely together in advising small businesses in setting them up based on, you know, what the needs are and really taking into account all factors. So just wanted to share that with the group in case there's any of you who are not incorporated and maybe want to consider thinking about that. So you're incorporated, if you are an incorporated company, your tax return is due 6 months after your fiscal year end. So if you do have a December 31st year end, you are required to file your tax return by June 30th of the following year. If you do have a tax payable position, even though you don't need to file your return until June 30th, you might have to pay taxes either by end of February or end of March, assuming a December year end. It all sort of depends on certain conditions that are met for each of the corporations. So what that means is you kind of need to know what your tax position is earlier as opposed to later. So don't wait till June to start the process on doing your return, because you don't need to file till June 30th. You need to know whether or not you're actually going to be in a potential position to have to pay tax, in which case it would be due much earlier than when your tax return is due. So just wanted to point that out. And then the other thing is, as you grow and become more profitable, and if you actually owe tax at any point in time, typically when you start owing tax and you have to pay more than $3,000, installments might start kicking in, and you need to plan for those, because those will be cash outflows to you throughout the year and not just when you file your tax return. So, so tax installments do come into play as well when you're forecasting your cash flows. I think that's a duplicate. Okay, the other piece I wanted to throw out there was that there are SHRED programs in place. I'm not sure how much you know about them, but I just wanted to basically share with you that there is an SR&ED program, which is your Scientific Research and Experimental Development, which is a program that's been put in place by the government for any of you that are sort of testing new ideas out there and potentially incurring costs as part of the research and development of those new products or services you're offering. And so just know that there is a program in place to help with that, and it's actually quite a pretty good program to really help, even just from a cash flow perspective, because there's a lot of costs that go into research and development and there's no revenue at that stage. So some of these costs you may be able to recover by way of applying for the SHRED program. So I just wanted to see, maybe you can just give me a thumbs up. Is anybody using your reaction button? Give me a thumbs up if you are filing a SHRED claim as part of your taxes. I'm just curious to see. So I don't see any, but I'm not sure if that's just because I'm not seeing any or if there were none. But anyhow, I did want to point that out to you, that there is a SHRED program, and if you don't know much about it, please reach out and try and learn more about that program. It might help you.
Rosanna, if I could jump in, would you mind giving a 30-second brief into what SHRED is?
Sure, no problem. So just at a very high level, because SHRED is very complex in of itself, but it's basically a government program where the government looks at the inputs in terms of research and development. A lot of it comes down to, so for example, a technology company, if you're trying to develop, the IT, the program behind the IP to the type of product or service that you're offering, there's a lot of time that goes into that programming piece, and you might kind of say, you're going through various iterations of trial and error, and you might make some mistakes along the way, and then you need to kind of go back and fix things to get it to work the way you intended. Or if you're in the manufacturing space and you're doing some prototypes and trying to make sure you develop your product appropriately, and you may need to go back and rework it because it didn't quite work out the first time around. Those are things that may be expenses that you may be able to claim as part of your SHRED program. And it's basically another section of the tax return where you would actually have to compile what your costs are relating to the research and development that you did perform. So you need to have some record keeping in place, although it's not as onerous as people might think. And if you work with somebody who can kind of guide you along the way, there's always templates that we can provide to people to help them track their time as part of the claim process. And then there's also, so there's two parts to it. There's the financial component to the SHRED in terms of the calculations that are put forward there, and in determining, what some of the costs are related to the SHRED, and you get a percentage of that back from the government. And then there's the technical component, which is what we call the write-up, or you need to put a story together in terms of what you're doing, what issue you're dealing with, what problem you're trying to solve, and how you went about it. And that's going to be the storytelling to support the financials and the numbers or the claim that you're putting forward. So I don't know, I hope that sort of gives you a bit of an introduction to it. It is much more complicated than that, and I'm not doing it justice by just speaking to it at such a high level. It is so individualized and case by case in terms of whether you're eligible or not eligible. But it's always good to A, know that the program exists, and B, talk to somebody who is involved with SHRED claims to see if you have an opportunity to take advantage of that program, because it is extra cash in your pocket if you are SHRED eligible. And I do know there's also some financial institutions that are lending against SHRED claims from a cash flow perspective. So if you have filed a SHRED claim in the past and you've been successful in obtaining the cash refund from the government, some financial institutions will actually lend against the SHRED claim. So because the SHRED is, you receive it at a specific point in time, the bank might lend you money to help you until you actually get that SHRED money back from the government after you put forward your claim. I hope that I said that right, but that is some of the programs and financing that's in place to help companies from a cash flow perspective. So anyhow, if you are interested in learning more, please reach out. I'm happy to have a more in-depth conversation and see what might apply to your particular situation. Now, is there anything else on that front that you were maybe looking for, or is that kind of okay for now?
No, that was awesome. Thank you.
Great, thank you. Great question. Okay, and the other thing I wanted to talk about too, and Nafis spoke to this at the onset, which is really some grant programs and really knowing what programs are out there and taking advantage of them. Grant programs are a great way to get, I'm gonna say, financing or cash for your company to help with, you know, either the startup stage or to developing a new product or entering a new market, or maybe for marketing. The grant programs are usually pretty specific in terms of what they're funding. So there is an application process, and you need, you know, to sort of go through that. There's also a number of providers out there that do also help you write your applications. So if you feel like you're not equipped to be able to do that or don't have the time to do it, you know, there are people out there that do that as part of the professional services that they provide. But I do find, you know, a lot of entrepreneurs and startups tend to tackle these on their own, and that's perfectly fine. Just the important thing there is be aware of them. And I think places like YSpace and in supporting entrepreneurs and giving them, you know, updates and providing them the tools and the information to go about even just knowing to apply for these grants is huge, because you don't know what you don't know. So, you know, kudos to YSpace for, you know, talking about some of the grants that are being put on by Markham. And I encourage all of you to take a look at the terms of those grants and the eligibility criteria and see if it fits for your particular circumstance. Once you have investigated sort of the grant programs in place, read the terms, make sure you understand what they are, because some grant programs are considered, you know, here, I'm going to give you $10,000. You do not need to pay me back. And then there's others where it's treated more like, here's $10,000. It's interest free, but you need to pay me back in 5 years. So you need to kind of, that's just an example. So you need to really be familiar with the terms, and then also be familiar with what the expectations are from a reporting perspective or any covenants that might be in place as part of the grant application program. So one of the things that I do know, the Markham grant that was being spoken to earlier, it does have some requirements around, you know, cash flow forecasting and making sure you've got that. And I'm sure there'll be also some financial reporting requirements either during the grant period or at the end of the grant a completion date or maturity date. So you really need to be on top of all your financial reporting, really applying some of the concepts that we talked about today from a cash flow projection perspective, and being able to put that to good use to help you get some additional financing through these grant programs. So bottom line, know what's available to you, seek them out, and apply. So a few other things I want to touch upon, just because it does impact cash flow and it does impact running a business, is there are sales taxes that you may need to pay. So if you're a business that, if you've registered for HST or GST, irrespective of making sales or not, you need to be filing a GST or HST return. Typically the threshold is if you have sales over $30,000 in any given year, or over the last 4 quarters, but that's really in any given year, then you should be registering for HST. It is mandated at that point. That being said, if you have less than 30,000 in sales, you may also want to consider registering for GST or HST, because any of the invoices that you actually pay GST or HST on, you can actually claim the input tax credit and get that GST or HST back, even if you don't have any sales at that point. So we have worked with a number of startups that actually choose to register for the HST as of day 1 of operations to be able to recoup back any of the HST that they've paid, even though they don't have any HST that they've collected. So just just a thing to consider. And then the other thing, just from an HST perspective, when you are looking at sales, you have to keep in mind that the sales taxes that you charge are based on the place of supply rules. So where are the services being provided? For example, if you're providing services outside of Ontario, you may need to charge the rate in effect, or the sales tax rate in effect for that province. So just know it gets a little bit more complicated. It's not just as easy as using the Ontario rate. It is pretty simple if you just do business in Ontario, but once you start going across provinces or territories or into other jurisdictions, that's when you need to make sure you're on side with that. And then if you are registered for HST, you need to make sure that your registration number is included on all of your sales invoices. So, you know, typically what we've always advised clients to do is, you know, never pay HST to someone if you don't see an HST or GST registration number on the invoice, because you just don't know if they're collecting that additional and they're not registered and not remitting it to the government. So that's kind of where that comes into play. You want to make sure, not that we're saying that that happens, but you want to make sure that you're protected and that you're paying, you know, your HST when you should be paying HST, and that it's being remitted to the government appropriately once it's collected. And then just in terms of the HST, if you are registered and looking at, you know, the amount of your sales, there's some thresholds here in terms of when you need to file your return and when it's due. So if your sales are between 30,000 and 1.5 million, which is probably where most on this call or on this conference might fall, then you are only required to file your return on an annual basis, and the return is due 3 months after your period end. So it really depends on when your fiscal year is. That being said, you could elect to file more regularly as well. So that's an option, and some people opt to do that just because if they are paying out more HST than they're collecting, they may want to file more regularly throughout the year, say quarterly, to get that money back. So that's something to think about. And then you'll see there's other thresholds depending on where your sales are at as to when your HST filings are due. I'm not going to go through all that. These slides will be circulated with you post-event, so you'll have all of this at your fingertips going forward. And then if you have employees, there's some other things obviously you need to think about in terms of running your business, in terms of whether or not you need to be registered for workers' compensation. So please take a look at the rules around that, and I strongly suggest you look at the WSIB website to make sure you're up to speed on whether or not you should be registered for that. And then there's other payroll tax registrations that you need to be aware of once you start hiring employees. So so just be aware of them, because navigating sort of all of the different taxes and making sure that you're compliant can be daunting when you're first starting your business. And like I said, you don't know what you don't know. So always best to check with your advisors and make sure you're on the right track and doing all the right things so that you know, you don't get into any or run into any issues later on down the line, or any penalties and interest for non-compliance. So and again, this is not meant to scare you. It's just to make sure that you're doing all the things you need to run your business and pay your taxes. Another thing that I wanted to just point out here is that sometimes when we're starting up our business, there are people that we would consider employees, and then there are people that we would consider independent contractors. And you're probably wondering, like, what's the difference and why do we care and why is that important? Well, it is very much important, because if somebody is an employee, there is going to be like CPP and EI deductions that need to be taken, versus somebody who is considered an independent contractor would, you know, basically send you an invoice, you would pay the invoice, and away you go, and you don't have any withholdings. However, if that independent contractor that you hired to do work for you actually doesn't have, for example, other work with other companies, and they work solely for your company, and you dictate the work they do, you dictate their hours, when they work, where they work, that could be viewed as an employee and not an independent contractor, even though there's an invoice to support that. And if that's the case, obviously that individual will have their own sort of tax issues to deal with, but you as a business who hired that person that you thought was an independent contractor, you could be liable for the CPP and EI that you should have withheld because they were technically an employee and not an employee, technically employee and not an independent contractor. So that's why it's super important to make sure that you do your due diligence when you are hiring contracted individuals to support you in running your business. Some of the factors to consider when you're, and I think I mentioned these, but just so you have them, is who controls their schedule, who provides them with the tools, can the worker decide to hire assistants, who has the opportunity for profit and loss. These are just some other consider points. This is not an all-inclusive list. There are a whole bunch of things that need to be considered, and you really need to look at this on a case-by-case basis. So it's not as straightforward as you might think, but nonetheless, it is something you need to be thinking about, because you don't want to be liable down the road where you should have withheld CPP and EI and you didn't because you thought they were an independent contractor. So you're just as liable as that individual. So know that, and CRA had been cracking down on this recently. I mean, so just know. The other thing I want to just, because it's timely in terms of where we are right now and in our economy and what's going on around us, is that, you know, obviously we all know about COVID-19, which is why we're having this meeting virtually versus in person. But with the COVID-19, the government has provided some relief programs in place to help support companies and supporting them to remain viable in business, and supporting some of their cash flow needs, because there's going to be some of those fixed costs like wages and payroll of people and no or little revenue coming in. So there are some programs in place. I'm not going to go into the details of these because I'm not sure how applicable each of these are to the people in this conference right now. But if there are any of you that may qualify for these, I strongly suggest you go to the website that I've listed on this slide here. It is probably your best source of information. It does change on a regular basis. The reason being is the government is continuously coming up with new programs or more details around the programs and who it applies to, or just sort of the administration of the program. So know that this is a site you may want to look into to see whether or not you qualify, because if you do qualify, there is an opportunity here for you to have some, I'm going to say, relief from a cash perspective from the government for short period of time. A lot of these programs are in place for a 3-month period, March 15 to June 6. So they are happening right now. And again, there's specific criteria and eligibility requirements and processes to follow, but nonetheless, a great opportunity to take advantage of some of these relief programs. So I'll leave it at that. I'm just being cognizant of time and want to leave some time for Q&A, so I'm going to skip over my question slide and move right on to the technology and how we might be using that to improve some of the accounting processes. And I know earlier there was a question from someone about, software and which ones we should be considering. But I do want to just, instead of maybe having a discussion on this, I just want to speak to this a little bit, just again, cognizant of time, is, there's different ways that we could be tracking our income and spending for our business. What I do find is when companies first start up, for the most part, people are using Excel and just, noting down all of their revenues and expenses or HST, that's paid, and tracking it that way. There is absolutely nothing wrong with doing that, in particular in the early days when the number of transactions are quite limited, and it's probably very easy to use Excel to support any record keeping that you might have. The key is the record keeping is happening irrespective of the program that you're using. So that's super important to do. There's likely improvements that you can make. Excel is a great starting point for most people, but as your company starts to grow and get more sophisticated, looking at a potential, off-the-shelf accounting package, and they're not that expensive these days and pretty user-friendly. You can actually have a lot of your accounting recorded through one of the off-the-shelf accounting packages, so that even when you're generating an invoice, it's automatically posting it or recording it to your GL and recording your entries as you go. And so it will help in terms of being able to generate financial statements even at the push of a button at any point in time, versus the Excel schedule needs to be converted, and financial statements need to be prepared based on that information, versus using accounting software, and literally you enter in the transactions, and then there's an option for reports and generating a balance sheet or an income statement or cash flow statement directly from the program. So just know that. And in terms of some suggestions with some of the programs out there, there is Xero, there is FreshBooks, there is QuickBooks Online. Receipt Bank is actually an application program that sort of works together with one of the accounting packages. So for example, it could work together with your Xero software, and you basically, use your cell phone, you take a picture of, for example, a receipt that you have, you enter in a couple of fields, like descriptions within a couple of fields, and then it automatically posts the expense into your accounting package. So accounting's come a long way from just sort of your desktop version of accounting packages, which still exist. So QuickBooks actually has a desktop version and an online version. And what they mean by the online version, and Xero and FreshBooks have the same capability, is just your accounting system's in the cloud. So you can actually access it virtually from anywhere. You don't have to be, in your office or at your desk to be able to, or on a particular laptop, you may only have one user license. So you could be in the cloud, and you could give access even to your accountant to be able to go in and see where, your numbers shake out, or you have some questions on a particular account. You can easily have those types of conversations through remote login. Obviously, you need to be careful because you want to make sure that all your data is always secure. So you've got to make sure you've got a good policy around that, and making sure you're careful as to who you give user access to and who has access to passwords, and making sure you change your passwords on a regular basis. But nonetheless, a lot of companies are sort of moving towards what we call the cloud accounting route. So these are just some examples. I'm not going to say one's better than the other, and I'm sure there's others there that I haven't put on this slide, but these seem to be the ones that most of the companies that I've sort of worked with have opted to use recently. So just in terms of using technology to our advantage, there is what we call sort of the old-fashioned method or the high-tech method. So when it comes to, for example, invoicing a customer, if we want to think of the old-fashioned way, and there's nothing wrong with it, and it's not, it is actually still very widely used in practice as of today, is you basically, you create an invoice, you email the invoice to your customer, And then when you do that, you record the invoice in your accounting system. And then when you actually get paid by your customer, you have to match that cash receipt to that actual sales invoice and then close it in the system to show that that's already been paid and collected. So that's actually, even though we call it old-fashioned, it's still happening today as we speak. So it's not that old-fashioned, it's just in this world of technology, there are other options out there to do these in a more efficient, perhaps. I'm not sure if that's the right word, but definitely it is efficient to have some sort of cloud-based system where you can, create the invoice through the actual software program. So in this example, we were just using Xero as an example, as a software package, and then Xero would actually email the invoice out to the customers. Xero would automatically record the invoice for accounting purposes, and then when the cash is received, Xero actually suggests where to apply that cash to and which invoice. So it's all being driven by the computer program, and it reduces some of the manual intervention. The key though is we don't want to rely solely on Xero and everything it's doing. You also need to make sure you review it and that it's appropriate. So you do need to have a little bit more monitoring controls in place, if you will. When it comes to sort of recording a purchase invoice, and again, this sort of old-fashioned method is still happening as of today, so it's not that old-fashioned. I'm going to repeat that again, but it's basically, you get an invoice, or there's an invoice that your supplier gives you, you throw it in a shoebox or you send it to your bookkeeper. Your bookkeeper has to manually record that invoice in the accounting system. And then they, when they actually make the payment, they have to show that that invoice has been paid. And then they actually have to file the invoice in a filing cabinet of some sort with lots and lots of paper, and it's stored somewhere within your office. And then at some point, years and years later, you either decide to continue to keep it or you pitch it at some point. You always want to make sure you're keeping at least 7 to 10 years of data to help support any tax return filings for your business. Alternatively, you can use the high-tech method, and I spoke a little bit about that receipt bank, which is taking a picture of the invoice, and then that automatically would update the accounting system for the information. So know that that's an option too. Just like retrieving an invoice, if you have to ever go back to look at an invoice, or you wanted to go check something, what you paid for something or what you charged a customer, if we were kind of doing it what we call the old-fashioned way, you'd have to go to the filing cabinet and basically hope that you can find it and it was filed in the right place. And in this day and age too, right now, with what we're going through, that would mean going into the office as opposed to maybe not. And we know that, with the lockdown, it's a little bit more complicated. So, there is some advantages to kind of, and I find, this whole scenario we're in with COVID has really put some stress tests on IT systems and on companies, and it's really forcing people to revisit the way we work and the technology that we used to be able to work from remotely and from wherever we are. So this, these new cloud-based accounting programs, I think, in light of COVID right now, may become even more popular going forward, just because it allows us to work remotely or within our offices. At least you have a choice. So in retrieving an invoice using Xero, you basically open up a program. You can use a search function and search for the invoice by date or supplier or amount, and then you basically open a copy of the picture of the invoice that you had previously taken and be able to kind of see it right then and there. So that search function could save you a lot of time and effort and maybe frustration if that invoice hadn't been filed appropriately in our filing cabinet. So know that there are some options out there to save some time and to make some processes more efficient. Same with maybe asking your accountant a question. If you're working with an accountant and you do have a question, you might be sending your accountant a screenshot of the desktop version of your QuickBooks. You might ask them about what changed or make a change, and then you may need to resend it to your accountant. So there's a lot of back and forth and a lot of screenshots versus, using some of these cloud-based systems. They really allow you to interact with the program remotely, and your accountant is able to log in with your permission. Obviously, you would have to set them up to do that. They would log in at the same time that you do, and you can look at the same things together and talk about them right then and there. And if there's any changes to be made, it's all done in real time. So there's definitely some advantages in these programs. And I think for now, it's just knowing that they're out there, and also know that there's nothing wrong to continue to do and use the programs you currently are using. It's really whatever works for you, whatever you think is ideal for your particular situation, and being able to utilize the resources you have as best you can. So again, knowing is half the battle, so just know that accounting has changed, software programs have changed and evolved, and there might be something else out there that might be better suited to helping you run your business more effectively and efficiently. So just be aware of them, and I'm sure that there'll be something else that comes out in the next few years or a couple years or a year from now, who knows, that might be even more efficient than what's out there right now. So just basically what I'm trying to say is know what's out there, know what works for you, and be comfortable with that. Okay, so that's it at this point. Maybe we can just check to see if there's any questions. I recognize we've got about 8 minutes left, and I do have homework for you, so you're gonna love me for that, I know it. I'm probably gonna get the worst ratings ever on this, because I don't know if any of the other presenters gave you homework, but I'm going to. But before I do, and I'm hated, I do wanna answer any questions you might have at this time. And Navis, maybe you can help me navigate it through and see if there's anything that you see on your end that I might have missed.
Sure. I know that there were a few questions that came up about using Xero versus Wave or QuickBooks. Do you have any thoughts on that?
I'm not going to speak to that, just because I do find that it's a bit of a personal preference, and I do find that, for example, if you're in a certain industries actually take a liking to certain software. So some like Xero better, some like QuickBooks Online better, just because of some functionality, or companies that have foreign exchange might like certain software better because it's just easier to use or navigate versus some of the others. So it's really hard to say. What I really recommend is, before you actually purchase any software or do any contract with anybody, have each of your providers do a quick demo with you and see if it works for your particular situation. Ask questions, have them show you. Maybe there's free trial periods you can take advantage of, so that you're not committed and you get to kind of see the user experience and see if it works for you. So that's sort of what I would say, because I don't know that one's better than the other. It's just some work better for some companies than others, or for some users better than others. So so do take advantage of those demos or free trial periods to see if there's one that you like better.
So perhaps, Rosanna, this is where we should maybe end off. And did you want to talk about the homework, and then we could wrap up?
Just real quick, I promise, and please don't hate me, but I'm basically, this is for your own I'm going to say purposes. So we used a template today in working with Becky's Bouquet, and my homework to you, which is really probably more of a challenge. I'm not going to test you. You don't need to submit it to me or to Navis or anything of that sort, but we do welcome it. If you do want any feedback on your cash flow forecast, you're welcome to send it along to us. But basically, you'll see that I believe I labeled it exercise 3, and it's your company, your cash flow projection template. Use that as just maybe a starting point. If you don't already have something, you're welcome to use, if for those of you that are preparing one already, you probably don't need to do this because you're doing cash flow forecasting as it stands, but for those of you that haven't done it, it's just good to actually use the concepts we learned today and apply them to your own personal businesses and situation. And if nothing else, if you're looking to apply for the grants, you might need this down the line. So it's really just kind of giving you a starting point to start pulling this information together, exploring, playing with it. And if you are looking, again, if you are looking for feedback, feel free to reach out, and we're happy to provide some feedback and give you some guidance on that, so that we can get you started on your way and make this sort of a best practice for you to continue to do on a regular basis for purposes of just managing your business and being not only, being very successful and thriving and knowing, what your cash situation is going to be or what you're, at any point in time, and being well prepared and well versed. And I think with COVID going on right now, even some of the most successful companies right now are actually struggling and putting together financial forecasts because there's so much uncertainty, and coming up with some of those assumptions and is proving to be very difficult, but yet an exercise that's super important and that a lot of people are paying attention to. So really I'll leave it with you in terms of whether you want to do this or not, but it is something that I strongly encourage and recommend that you start doing if you haven't already. So Navis, back to you. Before I do that, just wanted to say thank you to all of you for participating tonight and spending the last 3 hours listening to me and hanging in there throughout the session. I hope that you found it useful, and I do wish you all the best and much success with all of your companies. So thank you. Navis, back to you.